Welcome to Synthetic Alpha AI, where artificial intelligence meets institutional trading. Let's decode the market.
90% of Forex traders lose money, not because their strategy was wrong, because of what happened after they entered the trade. There's a trader who wins 7 out of 10 trades, another trader who wins only 3 out of 10. The second trader ends the year with more money. That single fact breaks almost everything beginners believe about trading. And by the end of this video, you'll understand exactly why, and what most traders get wrong before they even open a chart. There's one mistake near the end of this video that even experienced traders make without realizing it. It's not about entries, it's not about indicators, it's something far more dangerous because it hides in plain sight. Let's start at the beginning.
When most people start trading Forex, they search for one thing: the perfect strategy. They study moving averages. They study candlestick patterns. They watch hours of videos on support and resistance. And there's nothing wrong with learning these tools. The problem is what happens next. Most beginners believe that if they find the right strategy, winning becomes automatic. But here's the problem. No strategy wins every time. Not the professionals, not the algorithms, not even the most advanced institutional models. Every strategy, no matter how good, will eventually produce a losing trade. That's not a flaw. That's how markets work. So if losing trades are guaranteed, what actually separates traders who survive from traders who don't? This is where things become interesting.
Picture two traders, Trader A and Trader B. Both use the exact same strategy. Same entries, same signals, same market conditions. Trader A risks 5% of their account on every trade. Trader B risks 1%. They both hit a losing streak, 5 trades in a row. Trader A is down almost 25%. Trader B is down about 5%. Same strategy, same losses, completely different outcomes. This is the part most beginners never see coming. The strategy didn't fail. The risk management did.
Here's something rarely explained clearly. Losses and gains are not symmetrical. If an account drops 50%, it doesn't need a 50% gain to recover. It needs a 100% gain. Let that sink in. A 50% loss requires double the effort just to break even. This single mathematical fact is the reason so many traders with excellent strategies still fail. They're not wrong about the market. They're wrong about position size. But this isn't the biggest mistake traders make. There's another one, far more common, and almost nobody talks about it. When risk is too high, something happens in the brain. Fear takes over logic. A trader who risks too much on one position starts watching the chart differently. Every candle feels personal. Every pullback feels like a threat. And under that pressure, traders do the two things guaranteed to destroy an account. They exit winning trades too early, out of fear, and they hold losing trades too long, out of hope. Not because their strategy told them to, because their nervous system did. This is why professional traders often describe risk management as protecting their psychology, not just their money. When the risk on any single trade is small, the emotional pressure shrinks with it. Decisions become clearer, patience returns. But small risk alone isn't the full picture. There's a second layer most traders skip entirely.
In probability theory, there's a concept called risk of ruin. It measures the likelihood that a trader eventually loses their entire account, even with a strategy that wins over time. Historical studies on trading and gambling systems show something surprising. Even a strategy with a positive edge can still hit a losing streak large enough to wipe out an undercapitalized account. This doesn't mean every strategy fails. It means position sizing determines whether a trader survives long enough to let their edge play out. A profitable strategy paired with reckless position sizing can still end in ruin. A mediocre strategy paired with strict risk management can often survive and compound over time.
This is the part almost nobody puts in beginner tutorials.
Professional traders rarely talk about winning every trade. They talk about three things: position size, maximum risk per trade, and maximum drawdown before stopping. Many professional trading desks risk far less than 1% of capital per trade, not because they lack confidence, because they understand that survival comes before growth. A trader who protects their capital gets to keep playing the game. A trader who doesn't eventually gets removed from it. Then everything changes once this idea is fully understood. Now, here's the mistake even experienced traders make. They correctly set a stop loss. They correctly limit risk per trade. But then they take too many trades at once across different pairs without realizing those pairs are correlated. If Euro USD and GBP USD move together and a trader risks 1% on each, they might believe they're only risking 2%. In reality, if both trades move against them at the same time, the actual risk behaves closer to a single, much larger position. This hidden correlation is one of the most overlooked risk factors in retail trading. It's not about ignorance of risk. It's about underestimating how connected different trades can be.
Strategy tells a trader when to enter a trade. Risk management determines whether that trader is still in the game a year from now. Markets don't reward the trader with the most confident strategy. They reward the trader who survives long enough to let a good strategy work. That's not exciting. It's not flashy. But it's the difference between trading as a hobby and trading as something sustainable. Historical data and long-term trading studies consistently point to the same pattern. Risk control, not prediction accuracy, tends to separate traders who last from traders who don't. That doesn't guarantee any individual result. It simply shows where the odds tend to lean.
So here's a question worth sitting with. If you had to give up either your strategy or your risk management, which one would actually protect your account longer? Let me know your answer in the comments. Educational purposes only, not financial advice. Trading Forex, CFDs, and synthetic indices involves high risk. Past performance doesn't guarantee future results.
Until next time, stay patient, stay disciplined, and trade with Synthetic Alpha AI.